And Aishwarya, good afternoon. It's been a subdued sense for the markets today. And it's not just today, but we have fairly had a benign start to this year itself. Geopolitical tensions doesn't seem to ebb. And now we have fresh trade tensions between US and EU. So last year it was all about protecting capital for investors. Do you think this year also it's going to remain the same?
Yeah, good afternoon, everybody. We all expected this year to start after a very disastrous market in 2025 to be 2026 to be a better one, but life doesn't behave the way we want it to behave. And what we have seen is that not only the FI selling has increased in this last initial 20 days, but the geopolitical scenario globally has gone to a next level altogether. The whole paradigm between India, China, and US is now shifted to India, EU, and which is reflected in the risk of sentiment, where we are seeing gold and silver making everyday lifetime highs, and whereas some markets, specifically India, have seen continuous selling by FIs. But we have to also understand that apart from this geopolitical situation, which is affecting Indian market, there are certain other things also which are more India specific. Now, if you see in the last couple of days, our currency has also depreciated from almost 88 and a half, 89 to almost 91 as we speak today. That is also giving uneasiness to the FIs and overall macroeconomics environment there. And second is if you look at there's been some outcome related to Flipkart where we saw that court has said that they will have to amend those taxation things, and with budget around the corner, this is basically giving further, I would say, reason for global investors to look India in a different sense, and that possibly is also worsening the selling situation which is there. And last but not the least, what is really important was earning. The expectations for this quarter was muted. We are very early into this quarterly season, but there has been no big fireworks, right? Some of the banks and IT companies, including oil and gas like Reliance, have come out, but they are not really giving market reasons to hold on to that. So, though we are very early to that, but I think that all combined together is leading to such kind of selling in the market. We've already seen almost close to more than 30,000 crore of selling by FIs in this initial 20 days of the market. And we believe that trend of the market, at least for the very short term, look a bit bearish.
Okay, got it. Aishwarya, I mean, given amidst all of this trade and tariff row between US and European Union, do you think that the EU can be the next destination for India because it has been diversifying its exports to the non-US markets?
I definitely think so, and I think we are very close as been informed that we are very close to coming up with a new trade tariff agreement between EU, and I believe there could be no better time than this. But we have to understand that EU cannot be a complete substitute for US for any of the country, including whether it is India or China. So this could be the small fillers which can help you to maintain your export data, but they can completely substitute that. So I believe we have already done FTA with many other countries like New Zealand and others, and EU will also be a part of this whole exercise. But I think in Indian equity market will only get comfort or get confidence once we have some more clarity on India-US trade tariff situation, especially after this whole Russian and Venezuela oil thing. So unlike that, if that happens, even if we go and sign India and a big European Union trade agreement, I don't think it will change sentimental in a big way. That is very, very clear with us on that front.
Okay, that's quite an interesting take. But let's get back to earnings season. So far, the December quarter has turned out to be mixed, and markets seem to have already priced in that part of recovery. But what's missing is for the upgrades to kick in. So, I mean, what are you watching out for going ahead?
So we have some of those sectors which have come out. We have seen players like IT, some 4 or 5 IT companies have come out with the results, and some of those private banks and mid-sized bank, possibly some building material like Polycab and Havels have reported numbers. One thing is very clear that if you look at the numbers in detail and hear those management commentary, things are not that bad. Even in IT space, right from SCL Tech Mahindra, Infosys, we have seen earning guidance upgraded. We have seen that visibility, becoming more conducive on growth. We have also seen margin expansion happening across all of them. Even Wipro have done decent number, though they have guided a bit lower. So we are not seeing any worms around that, but market is in no mood to appreciate anything which is coming in line. Right. On the other hand, we have seen slight slowdown on numbers of Reliance, especially on retail side, and we saw Reliance has been under pressure since then. On banking side, there has been players like Federal and all who have reported, mid-sized bank have reported very decent number, but players like ICICI Bank or SDFC just reported numbers more or less in line with expectations, and markets are going very, I will say strong on that number. So I won't say numbers season has been bad so far, but you are not seeing any big fireworks coming from any one of them so far, and that is what market is getting more jittery about, because earnings growth is what I think that will be the only savior to the Indian equity market here. And if we see any slowdown or further earning cuts, which we didn't see in quarter two, if we see it happening in this quarter, then possibly we might see some more tough time for Indian market, at least for the quarter or so. So that is very, very, very crucial. We are very hopeful things will start showing up because the GST benefit and all other benefit will start accruing to those numbers. But let's see how this quarter goes through.
Okay. Sure, you were talking about how HDFC and ICICI Bank maybe have not really appreciated the street and not really surprised the street, but Federal Bank had done quite well. So, I mean, how would you suggest investors to play out this theme? Because earlier, of course, heavyweights do matter for the markets to make an up move. But right now, if the mid and small size lenders, if they are doing well in the terms of growth perspective, would you suggest investors to be parking their money there?
So at Fident, we came out with our initial research very recently that we believe that SMID banks, which is small and medium-sized banks, is something which looks very, very attractive. And if we see the reason behind that is, the 4 or 5 parameters of banks, whether it is asset quality, of operating performances, names, when you look at their ROE and an ROA from 5 year compared to the last 5 year before, there has been a remarkable improvement in all of those parameters. But at the same time, if you look at the valuation catch-up has just not happened. Right? We have seen when Federal reported numbers, the stock has actually moved up 14-15% in 2 sessions. That is the catch-up which is happening in SMID as a banking sector. And at the same time, we've also seen in the last 2 months, majority of the global funds and strategic investors have bought stake in majority of this small and medium-sized businesses, whether it is Manappuram or Federal or IDFC First or many of them. So it basically gives you a kind of a support system that there is a lacking for this particular segment, and this particular segment has shown remarkable performance on operating parameters over the last 4 or 5 years. The only thing left out is valuation catch up compared to other private banks. So that's why even at Fidel we are very positive and going overweight on SMID as a banking per se, and we believe that is one place which is expected to do really well in this calendar year. Just to give you some numbers, majority of them are trading between, like Federal is trading at 1.2 time price to book. Many of them are between zero point 0.8 to 1.2 time price to book compared to the larger private banks or mid-sized banks, which are between 1.5 to almost 2 times or even more on that side, with now a very similar ROE trajectory and other asset quality parameters. We understand the only thing which is required for it, the valuation catch up to happen, is the growth part. For SMID, they have to grow faster. And if we see the revival happening in the credit growth in the last December 14-15 days, we saw year-on-year growth of almost 14% plus. If that catch up with low interest rate in the coming times, SMID is a place to be, Rohit.
Okay, all right. That's the view from the SMID banking pack. But, small caps in general, today also we are seeing that the BSE small cap index has hit an 8-month low, and over 200 stocks from the index has hit a fresh 52-week lows. I mean, if you go by the data, last year the small cap funds had hit record highs despite muted returns in terms of earnings growth. So, I mean, how do you see this trend to pan out, and what would you suggest investors to do? That despite, do you think that the worst of correction is also already behind, or the earnings is something that everybody should be waiting out for and think about before investing into small cap funds?
So a small cap is a very interesting place. If you look at last year, small cap index was down roughly 6.5%. And but if you go deeper, in the last year, small cap, which is with the market cap of say below 10,000 crore to say 5,000 crore, the deviation or the decline, if you see on equal weighted basis, was roughly around 24%. And if we go even below that, if I say hypothetically going from 5,000 to say 1,000 crore market cap companies on equal weighted basis, the decline was almost 28, 29%. And if we go below 1,000, which we say possibly micro cap, the decline was around 31, 32%. And if we add up the January data so far, I believe there would be another 3 to 4% decline on those equal time basis on small cap and micro cap. If we see on valuation, what has actually happened, if we started December 24, the premium which majority of the small cap was trading at compared to large cap was stupidly very high. It was around 70, 80%, which has actually come down to around 35 to 40%, which in line with the long-term average. But still, small cap are not very cheap. And second most important thing is if you look at that the in the earning good trajectory, if you look at mid cap has actually done phenomenally well over the last 4 or 5 quarters, but the earning good trajectory of small cap in the last 4 or 5 quarters has been very patchy, and it is basically in low single digit compared to mid twins of mid caps there. Now, if you look at the macro situation, looking at the growth and the government initiative and the RBI initiative and the lower interest rate, it all bode very well for small cap. And we also believe that after a very bad year for small cap in 25 and though the start of 26, possibly this year will be a year of revival for small and micro cap. But it will only happen once we start seeing earning started contributing meaningfully, which will obviously play out in this 2 quarter and H1 of the next financial year. So one has to be very watchful into buying small cap companies, businesses which has a very strong moat around them, unlevered companies, and where we're seeing there's a growth of around 20 to 25% visible over the next 2 years. Those companies, I believe many of them are now trading at between 15 to 20 time PE compared to 35 to 40 time PE 1.5 year back, is now becoming very interesting from investment perspective. So investors has to be very watchful about what kind of growth and valuation they are buying in small cap. And last but not the least, we might see a couple of months of volatility before things really settle through once we have more visibility on the earnings in the small cap space.
Okay, okay. Aishwarya, any sectors from the small cap space which looks comfortable from the valuation front, or is it completely going to be stock specific?
No, so if we like when our team is spending a lot of time and meeting a lot of this management, so as I said, many of the small cap companies were available between 30 to 35 or even at 40 time P 1 year forward, irrespective of whichever sectors. Now all are trading between even 15 to 20 time PE in that space. That includes whether so we are talk about fabric building materials, if you look at chemical companies or CDMO companies or even many of those Smith is not the way to look at it on PE, but valuation has become very very attractive. But we have to really understand what that if we are trying to buy these companies in that segment at around 20 time P or 17, 18 time P, the growth has to be there at least 20%. And that why one has to be very sure that we have to be in sector where you're able to turn around these kind of growth to really justify those earnings before market sentiments picks up. If your growth dwindles for any other reason, whether it is geopolitical or any other macro reason, possibly this 20 time P valuation come down to 12, 13 or 15 time P valuation historically that we have seen. So one has to be very sure on which sectors one should look at. Couple of sectors which we are very comfortable is BFSI. I think with whatever government has done on tax cut and GST cut, consumer sentiment looks pretty good. There are a lot of the small cap companies in the consumer that are pretty convincing on that parameter. And say some companies on the pharma space or auto inc is one area which we believe should be able to maintain higher growth. So there are a lot of good companies in small and mid cap size in the auto ancillaries which are trading between 15, 18 time P. That makes a good investment cases.
Okay, got it. Aishwarya, any sectors you want to point out which you believe could be at the risk of the earnings downgrades?
If we really look at the couple of sectors which we believe can see a lot of volatility is pharmaceuticals and chemicals also. So it's going to be very difficult to extrapolate their earnings about how they will play out, given such geopolitical scenario. Second, obviously, is any companies which have a higher export related activities, whether it is auto or whether it is any of the export X of IT, which we believe investors has to be watchful about their ability to play out on earnings side. But overall, if you see the larger part, whether it is BFSI, whether it is IT, whether it is consumer, we should be comfortable there. Even industrial and capital goods have its shares of up and down, but we believe the whatever momentum of government capex is there, should be able to maintain that kind of growth for majority of these companies. We have been categorically stayed away from renewables and railways and places like that because we believe we have very limited ability to understand the your ability to forecast those earning, and they might have higher probability of missing out on earning on that side. So this will be the couple of sectors which we believe can surprise negatively on the earning side.
Okay, okay, got it. But I mean, what about the realty space? I mean, we have some data saying that it's been a, worst start, a third worst start for this year. I mean, in last year also, in January itself, they declined by about 12%. And in 2016 is when they also saw a decline of about 11%. How do you see the realty space? Today also, it was one of the biggest sectoral underperformers. What would you suggest investors to do here?
So if you look at in calendar 25, I believe realty was the worst performing index, right? And I believe that kind of, you said that continues the trend even in this calendar year so far, though it's very early. So we are very, very negative on the space on real estate. We didn't invest in anything in that space even when we started. The reason that is in spite of, we are seeing lower interest rate environment, which is very conducive for real estate players. But if you see the way the pricing has inched up, over the last 4 or 5 quarters in the key markets of the top 10 cities in India. And at the same time, when we see the inventory piling up, though there is a huge consolidation which has happened in the industry, even in a city like Bombay, where there used to be like 10 large players which used to own 70-80% of the market share, it has gone down to between three players, which is between almost like 55% market share today. So in spite of this consolidation, the inventory level and pricing, we believe, are creating very difficult scenario, on that side. So we believe pricing possibly will remain a plateau. That will be the best kind of a scenario. And then system will create further pressure on the balance sheet of majority of these companies. So we believe it's going to be again a tough year in spite of lower interest rate, and we will particularly stay away. And that not only include real estate, we are also not very bullish on building material as a space. So I think the whole pie is something which we believe possibly will remain under pressure for more time in this calendar year.
Okay, okay, got it. But yes, I mean, just one last question before I let you go, Aishwarya. I mean, if you look at the gold and silver prices, they continue to hit record highs amidst all of this geopolitical tensions. Do you expect this trend to remain the same? Like, investors would prefer this as a hedge, or is there some speculative excess already built into these precious metals?
Definitely. I believe gold and silver are not behaving like commodities. They are now behaving more like currencies. And I believe that everything, if you see the kind of momentum which has happened in gold and silver, is more to do with the way central banks are behaving. It has to do everything with the way yield has moved in the last 6 months, and obviously the dollar weakness. You all understand that whenever dollar weakens, commodities do well. And this time around, with the dollar weakening, there is a clear-cut geopolitical risk which is developing from a majority of the non-US led banks who believes that if the dollar things can weaken further, it's better to stay into metals, especially in gold. So it's like lower confidence on fiat currencies is what which is moving the money into gold. And then we saw, that chain reaction pulls up and the kind of movement we have seen in gold. And specifically in silver, we have always seen that in a bull market, silver outperforms gold because silver has both industrial as well as store value funda. on that side. So we expect that whatever the moment has happened is very sharp. It is very difficult to predict how geopolitically things will turn around, and we will definitely see that things playing. If you see the geopolitical scenario continues to be a more problematic, with the further rally in gold and silver can't be ruled out. Silver, obviously, because it has this finding in AI and chips and renewables and whatnot, have a better case because of supply side issues also. But gold is definitely behaving a bit erratic in our understanding. So if we see, I think it has to do everything with dollar geopoliticals and how the supply side things is matched through. But we have to be very cognizant of the fact that whenever these kind of sharp movements comes, irrespective of any asset class, the reversal is also very sharp. So if something happens on geopolitical side, if there is some settlement or things improves over the next 2 3 months, the reversal could also be very, very sharp. But having said that, this is, I would say, a bullish trend which has been picking up. I won't be surprised to see it going further, because of all the things which I mentioned. But I will not also be surprised to see a reversal many times soon, especially in silver with the way it has moved, at least in the last 1 month.
Okay, all right. That is something that we need to watch out for. All right, with that note, we have to let you go, Aishwarya, but thank you so much for connecting with us.
Thank you. Thank you so much.